All right, let's talk about something that gets every investor's heart racing. You're scrolling through stocks and then you see it, a company offering a dividend yield of, say, 8%, maybe even 10%, and your first thought is probably, jackpot, this is an absolute cash machine. But hold on a second. What if I told you that incredible payout isn't a gift, but actually a massive warning sign that the company is basically eating itself alive? Today, we're diving deep into the dividend trap.
So here's the big question right up front. When you see a huge double-digit yield, is it a golden opportunity or is it a carefully laid trap? Because, and this is the key, sometimes the money a company is paying you, well, it's just your own money being handed back to you. And understanding that difference can literally save your entire investment.
Okay, to really get this, let's use a super simple analogy. Forget stocks for a minute. Just picture this. You're walking down the street and you see a pizza shop. The lights are on, but you look through the window and it's completely empty. Not a single person inside.
And just as you're about to walk past, the owner runs out the door and says, Hey, you, come on in. I'll give you a free lobster with any pizza. Now think about that. A busy, successful restaurant might offer you a free soda, right? But a free lobster from a place that's clearly struggling? That feels off. That's a huge red flag.
Exactly. Your brain doesn't go, wow, what an incredible deal. It goes, wait a minute, what's wrong with that lobster? You know, is it old? Is this place about to go out of business and they're just trying to clear out the freezer? This is the exact same logic you need to apply to stocks with crazy high dividends. It's an offer that seems way too good to be true, coming from a business that, on the surface, looks like it's in trouble.
So how does a yield get so high in the first place? Well, the math is actually really simple. The dividend yield is just the annual dividend divided by the stock's price. Now, there are two ways to make that yield number go up. The good way is for the company to make more money and increase the dividend. Awesome. But the dangerous way? The stock price collapses. If a stock's price falls from $100 to $50, but the dividend hasn't officially been cut yet, that yield you see on your screen instantly doubles. That high number isn't a sign of a generous company. It's the ghost of a much healthier stock price.
So, how do we spot the trap? How do we tell the difference between a genuinely good company and one that's about to fall off a cliff? Well, there is one fantastic metric for this, and it's called the payout ratio. Think of this as your number one essential safety check. It tells you if the dividend is coming from actual profits or if the company has started selling off the furniture to keep the payments going. And this slide breaks it down perfectly with another little story. Imagine Grandpa's fruit stand. In the healthy scenario, he makes $100 in profit. He gives his grandkids $40 as a treat, and he puts the other $60 back into the business to buy better fruit next year. That's sustainable, right? But now look at the dangerous way. Business is bad, he only makes $50. But he promised his grandkids $100. So what does he do? He gives them the $50 he earned, and then he sells his juicer for another $50 to make up the difference. The grandkids are happy today, sure, but what about next year? There's no juicer, which means even less business. That right there is the very essence of an unsustainable dividend.
So, the formula that captures this whole idea is the payout ratio. It's the dividend per share divided by the company's earnings per share. Or, put more simply, what percentage of the company's actual profit is it handing out to shareholders? This one little number tells you almost everything you need to know about how safe a dividend really is.
And this chart just makes it crystal clear. Look at Company A. It earns $2 per share and pays out $1. That's a 50% payout ratio, super healthy. It means half the profits are being kept to grow the business. But then you have Company B. It earns $1.50 per share, but it's paying out a $2 dividend. Whoa, that's a payout ratio of 133%. So where's that extra 50 cents coming from? It's coming from the company's savings account, or even worse, they're taking on debt to pay you. The alarm bells should be screaming at this point.
Now, as a general rule of thumb, for most established companies, a payout ratio somewhere in the 30% to 60% range is considered the sweet spot. It's healthy, it's sustainable, it shows they're profitable enough to reward you, the shareholder, while still having plenty of cash left over to reinvest and grow for the future.
Okay, but let's add a little bit of nuance here. Because while a payout ratio over 100% is usually a major red flag, it's not always an automatic death sentence. There are a couple of important exceptions you should know about. Here are the two main ones. First, you've got real estate investment trusts, or REITs. For them, weird accounting rules about property depreciation can make their earnings look artificially low, even when their buildings are doing great. So their payout ratios often look really high, but they're okay. The second one is cyclical companies. Think of a steel mill or a car company.
In a bad year, they might lose money. But they can use the huge pile of cash they saved up during the good years to keep the dividend going and not spook investors. So the lesson is, if you see a ratio over 100%, your next step is to go check the company's cash flow.
So let's bring this all home. What's the single most important lesson here? It's this. As an investor, your number one job is to protect your principal, protecting the money you put in. And chasing a beautiful-looking dividend yield without checking if it's sustainable is one of the absolute fastest ways to lose your money. Don't fall into the trap of letting a company pay you back with your own capital.
If you only remember one thing from this whole explainer, make it this sentence right here. A high dividend yield is the bait. It's shiny, it's attractive, it's designed to lure you in. But the payout ratio, that's your filter. It's the simple tool you use to see if that bait is a real, nutritious meal or if it's just a dangerous hook. So always think back to that simple story. Just remember, Grandpa's selling his juicer to keep the grandkids happy for one more year. A company paying out more than it earns is doing the exact same thing. It's sacrificing its future just to look good today. Never let yourself be fooled by numbers that just seem too good to be true.
And that leaves us with one final thought. The next time you're screening for stocks or looking at your portfolio, and that tempting 8, 9, 10% yield pops up on your screen, what's the very first thing you're going to check? Now, you have the tool to find the real answer. Thanks for tuning in.